What about Capital First? Well, which didn't face any pressure. This was a strong quarter. Asset quality saw an improvement as well. Shraddha Babla spoke to V Vaidyanathan, Chairman and Managing Director at Capital First, and began by asking him about the business mix of the company.
Yes, it has been a stated strategy for 8 years at a stretch now that we are largely and only going to concentrate on building the retail and the consumption and the SME financing book. So now that is almost touched 90% of the book. So corporate is relatively marginal in the scheme of things at this point of time.
All right. We have had some bankers who have raised concerns on their SME portfolio asset quality, while the others like Bajaj Finance don't see any red flags. What has been your experience with the SME and LAP book?
Well, now it's been 8 years at a stretch. The truth is that we have had absolutely no year, and certainly not even a single quarter, which has really bothered us significantly. It's been quite stable. Of course, with the kind of growth that we're seeing in India in consumption and in SME, we should of course be careful. We should no doubt we have to be careful on this front.
Okay, so you haven't seen any incrementally large write-offs as far as that book is concerned?
Not at all. In fact, if you see our results, the charge-offs this quarter is actually sequentially lesser than even the previous quarter, almost in the same zone. We are actually seeing the credit performance actually increasing, improving. So we think really we are not seeing any stress on the book. You know, let me say the biggest period of stress test was the demonetization or the GST implementation. They all went by quite comfortably. So we are actually not seeing any problem here.
So your total income for the quarter has grown by about 31%, but your OPEX has gone up by about 47%. Just trying to understand if this is the trend that we're likely to see going ahead. I'm just looking for some sort of a guidance with respect to the cost to income ratio.
As I mentioned to you, we are expecting the net interest margins to slightly come down. In fact, we've already seen it come down over the last quarter. We are actually seeing that our operating expenditure has come down and credit losses have come down. So in the end, without guiding for cost income ratio, which will probably be about 52-53%, we expect that the return on assets to continuously increase. We expect return on equity to continuously increase. If you see the return on equity for the last 25 quarters at a stretch, it has inched up from about 2% to 16%. We believe that net of costs, we believe this trend should continue.
Right. And so what about the timeline for the IDFC Bank merger to get completed, and by when do you expect all the approvals to come in place?
We think by December almost everything should be in place because all the significant approvals are behind. One significant approval that is in front of us and not yet received the shareholder approval. September 3 is the shareholder vote for IDFC Bank shareholders. Sometime later in the same month will probably be the shareholder approval process for Capital First shareholders, and therefore September I should say is a crucial month.
All right. And Capital First has picked up 7% stake in Village Financial Services for 15 crores. You also have a small stake that you picked up in Satin Credit Care last year. So are we continuing to look at similar tie-ups or small acquisitions, if I can call them, even in the future?
No, I can't talk about the future. These are very opportunistic and transactional cases.
All right, but you do intend to pursue the strategy of getting more and more tie-ups to expand the distribution base?
I mean, we are in the business of lending, so we always look for opportunities for tying up with people. But these are specific and opportunistic. There really can't be any prediction about how many more deals will happen and stuff like that.